You know, when stock markets are just absolutely soaring, it can feel like the rules of gravity have been suspended. The logic that governs the rest of the world, it just seems to melt away, and it's replaced by this new, exciting, and, let's be honest, often dangerous set of beliefs. So today we're going to dive into the flawed thinking that really takes hold during market bubbles, using the dot-com era as our guide to the bull market baloney we should all learn to spot.
Now, the great Yogi Berra, he probably wasn't talking about investing, but man, he might as well have been. In a roaring bull market, everyone feels like they know exactly where they're going, up. But without a clear framework, you're really just along for the ride. And as we're about to see, that ride can take a very, very sharp turn.
Okay, so let's tackle the biggest myth of them all. This really seductive idea that whatever has been happening is just going to keep happening. It's a psychological trap. You probably heard of it, called recency bias. And back in the late 1990s, this wasn't just a hunch. It was treated like an iron law of finance. And look, these weren't some fringe predictions from the middle of nowhere. We're talking mainstream, best-selling books. The logic behind it, it was dangerously simple. The market's been climbing 20% a year, so let's just assume that goes on forever. It's the classic case of trying to drive a car while only looking in the rearview mirror.
I mean, you can just hear the confidence in that statement, can't you? This was a professional fund manager on national television dismissing any talk of a bubble, and his justification, the growth is big. The thinking was that it was a new era, and the old rules, well, they just didn't apply anymore. But what happened next?
Well, the reality was absolutely brutal. Those very same stocks with the so-called big growth, they were decimated. A tech darling like Nokia lost 2/3 of its value. A company like Windstar Communications didn't just have a bad year. It was effectively wiped off the map, losing 99.9% of its value. I mean, that is as close to zero as you can possibly get.
And get this one, from a chief investment strategist, no less. This quote just perfectly captures that this time is different mindset. The whole argument was, hey, this is a new world order? Worrying about price? That's old school thinking. That's the worst mistake you can make. If the company was good, the price just didn't matter.
Well, it turns out price, yeah, it always matters. This number? $400 billion. That's how much investor wealth just vanished from one of that strategist's favorite stocks, Cisco Systems. To give you a sense of how massive that is, at the time, that was more than the entire annual economic output of countries like Singapore and Israel combined. Just a staggering loss.
Okay, this next one, this might be the most mind-bending statement of the whole era. A chief strategist at a major investment bank arguing that higher prices don't mean higher risk. That's like saying the higher you climb up a ladder, the safer you are. I mean, it just completely defies basic logic, right?
Yeah, of course the answer was a huge resounding yes. Higher prices absolutely meant higher risk. The NASDAQ, which was the epicenter of that whole tech boom, it just collapsed. It completely erased 6 straight years of what everybody thought were guaranteed gains. The recent past, as it turned out, did not repeat.
Okay, so if looking at the recent past is a bad idea, what about the really long-term historical record? The bulls back in the 90s, they loved to argue that stocks had always beaten bonds over the long run. But that argument, it has a fatal flaw of its own.
And that flaw has a name: survivorship bias. It's actually a pretty simple idea, but it is so powerful. When we look back at historical stock market indexes, what we're seeing are only the winners, the companies that survived. What we don't see are the thousands upon thousands of companies that went bankrupt along the way.
I know. These names sound kind of comical now, right? The Dismal Swamp Canal Company. But believe me, they were the hot tech stocks of their day. For every single company that survived from the 1800s, there were countless failures just like these. And by ignoring them, the historical indexes paint this wildly optimistic picture of what real investors actually went through.
So, okay, why does all this matter? Well, because when you adjust for this bias, the true historical record looks totally different. Researchers now estimate that early stock returns were about 2 percentage points lower per year than we thought. That difference is huge. It's enough to basically erase that whole argument that stocks were always superior to cash and bonds back in the day. The proof just isn't what it seems.
All right, this brings us to our third and final myth, and this one really ties everything together. It's the incredibly dangerous idea that if you found a truly great company, you can afford to pay any price for its stock.
Let me put it this way. Think about Michael Jordan, arguably the greatest basketball player of all time. Was he a bargain at $34 million a year? Absolutely. But would he have been a good investment for the Chicago Bulls at, say, $3.4 billion a year? No way. Of course not. Even the greatest asset in the world becomes a terrible investment if the price you pay is absurdly high.
And this brings us to the timeless antidote from the father of value investing himself, Benjamin Graham. And the logic here, it's just inescapable. A company's profits are finite. They can only make so much money. Therefore, the price an intelligent investor should be willing to pay for those profits must also be finite. It really is that simple.
Okay, so if we know price is this crucial piece of the puzzle, how should we even think about future returns? We've busted the myths, so where does that leave us? Well, instead of just forecasting, let's build a simple, common-sense framework for what the market might actually be able to deliver over the long run.
See, future stock returns, they really only come from three places. That's it. First, there's real growth. That's just companies actually earning more money and paying out higher dividends. Second, you have inflationary growth, which just means prices across the whole economy are rising. And the third piece, the most volatile one, is speculative growth, which is just the change in how much other people are willing to pay for the exact same stock.
So what happens when you look at the long-term historical averages for these things? You get about 2% for real growth, a little over 2% for inflation, and maybe another couple of percent from dividends. You put it all together, and you land somewhere around 6% per year. Now, I know, that is a far cry from the 20% plus returns people got used to in the 90s, but here's the thing. It's a sober, reasonable expectation.
And this table here really drives the point home. It shows what happened when starting valuations, how expensive stocks were high in the past. And look at the results for the next decade. They're all over the place, sometimes negative, sometimes pretty good. And while the average, funny enough, works out to our 6% number, the real takeaway here isn't the average, it's the wild swings. It's the sheer unpredictability from one decade to the next.
So, this leads us to the biggest, most important question of all. After looking at all this history, all these mistakes, all these numbers, what is the single unambiguous lesson?
And really, this is it. The only thing you can be certain of is that you can't be certain. The future will always find a way to surprise us, and it will be most brutal to those who are most convinced they know what's coming next. The greatest defense you have, your single greatest asset as an investor, it's humility.
Maybe the best way to think about all of this comes from the writer G.K. Chesterton. Blessed is he who expecteth nothing, for he shall enjoy everything. See, lowering your expectations, it's not about being negative or being a pessimist. It's about freeing yourself from the tyranny of having to predict the future. It's about being prepared for anything and being able to truly appreciate whatever returns the market does give you because you never treated them as a guarantee in the first place.